payment crisis, and macroeconomic forecast, a component-driven quarterly Bayesian vector autoregression approach. Sponsored by Sri Lanka Economic Association and the Department of Economics, University of Peradeniya. We all, as Sri Lankans, currently are facing an enormous crisis, an economic crisis, and also a social crisis by now. Many Sri Lankans are, as we discuss this, are on the road waiting for long queues for petrol, and many shortages are coming, and we are in a desperate situation. The root cause of this kind of a chaotic situation, nothing but the dollar shortages. Dollar shortages drive the economy crazy, and people are basically suffering. Politicians are giving promises, fail to deliver whatever they promise, and now they basically forecast things and warn the citizens, and the worst to come. That's the last message we got from the government. Why this crisis happened? The timely topic, Sri Lanka's balance of payment, will provide the answer for the present crisis situation. It's a timely topic, and the prestigious Economic Association, associated with one of the prestigious universities in Sri Lanka, the University of Peradeniya, also where I was graduated from. So it's a privilege to me to function as a moderator on this particular seminar, and it gives me immense pleasure to do my job here. Without wasting time, let's get into the business. So today's seminar presentation will be shared by three eminent scholars in the country. All three are from the Department of Economics, University of Peradeniya. First, Professor O.G. Dayaratna Banda. He's a product of Peradeniya, and he has done his master's also in Peradeniya and PhD from National University of Singapore, and he's also a council member of the Sri Lanka Economic Association. And he has occupied very important portfolios in the university system. He was the head of the department and the Dean Arts, and he has published in various prestigious journals and also international fora, and he has been visiting many foreign universities and a fellow academician in many other universities as well. So we will welcome Professor O.G. Dayaratna Banda to give us a quantitative look at the current crisis and a forecasting on this particular problem. Next, in the line of our eminent speakers, Dr. T. Vinayagathasan, again a proud product of Peradeniya, and he obtained his master's from Peradeniya as well, and he was a doctoral candidate for the University of Tokyo, Japan. And he's also serving the University of Peradeniya as a senior lecturer right now. And he also published immensely on various local and foreign journals. The third speaker of this evening, Dr. Thushari Vidanage. She's also a senior lecturer in the same department. She has been a graduate of the same university, and she is holding a doctorate from the University of Griffith Business School Australia. And she has also published articles in various journals and other peer-reviewed materials. So we warmly welcome all three eminent speakers on this very important and also timely seminar. And without wasting their time, we welcome the eminent scholars to present their paper.
Okay, then thank you very much, Dr. Ganeshmoorthy, for kind introduction to all of us. And also, on behalf of the department, I would like to thank the Sri Lanka Economic Association for collaborating for this basic event. And basically, what we are going to present is an ongoing results of an ongoing work of a comprehensive macroeconometrics model that has been developed to analyze and forecast the Sri Lankan economy, basically. So to start with, I will first present to you some stylized facts about the Sri Lankan economy to get some idea about as what basically has been going on for the last few years. And then we will actually present to you the results of our macroeconomic model estimation as forecast also. And if you can see this one, I have actually shown some key macroeconomic variables, but I am not going to talk about everything, but I would like to highlight you two key macroeconomic variables, that is the dollar-rupee exchange rate and the total debt, government debt to GDP ratio. And these two, actually, you can see since about 2014, these have been actually rising significantly, and this exchange rate and the debt to GDP ratio indicate basically that basically some troubling signs of a possible currency or BOP crisis in the future. So therefore, we know that this is arising from the budget deficit, and then it translates into a balance of payments deficit. And then when the balance of payments deficit is increasing, exchange rates tend to basically depreciate in a flexible exchange rate system. And also, second point that I want to highlight here, debt to GDP ratio, according to some scientific estimates by various scholars, indicate that for a developing country, this ratio, the most feasible ratio is going to be about 64%. And a ratio that is surpassing 64% is going to be in the domain of possible debt
or unsustainable debt, basically. So this is one of the things that I want to highlight here as a stylized fact.
We have been seeing actually descent in the Sri Lankan economy to a possible economic meltdown for a particular period of time. And what I'm highlighting is that it's not a sudden unknown collapse basically that we are seeing. And the second point that I want to highlight is actually this debt accumulation of huge amount of debt, external debt. And you can see in 2010, Sri Lanka has had 2005, actually we have had only $10 billion of external debt. And within 15 years, by 2020, this has accumulated to 56.3 billion rupees, out of which the bottom left hand you see 47% of that is from the market borrowings. And the 10% is from China, but IMF is very small, and the World Bank also a small amount. And you can see so this is very, very similar to the Latin American debt crisis that we observed in early 1980s. Accumulation of market borrowings, unsustainable borrowing from markets, and then inability to service debt and creating a crisis. So that this is actually, therefore, this number also tells us that it is the accumulation of huge amount of debt during the last 15 years, especially market-based borrowings, about 47% that we observe. And also, you can see the right-hand side of the screen, the amount of servicing that we had to do. from 2010 to 2018, only $2.2 billion, but 2020 to 2025 4-year period, we have to service about $4.5 billion. And this is another stylized fact that we observe accumulation of huge amount of external debt during the last 15 years period until 2020. Then when you look at the balance of payment situation, you can see the far right of the chart. We actually, normally there is a standard message given throughout the world that in peace times, more crises come. And you can see after the war, Sri Lanka has accumulated this aggressive open market operations to suppress rates. Monetary instability normally happens in a peacetime, basically. And you can see in 2019-20, the 2019, especially this modern monetary theory influx of money into the economy, and the budget deficit that was created by huge cutting of the revenue as well as increase of expenditure. We see that here balance of payments. If you are aware of the 2-gap model or 3-gap model, this is actually a classic case of transferring the budget deficit into a balance of payments deficit. A huge deficit has been arisen, and you can see in 2020 and 2021, balance of payments deficit overall was about 2.3 billion and 3.9 billion. And this is actually a direct result of deficit funding and printing of too much money, basically. It is very clear. And by the end of 2021, Sri Lanka has seen 3 years of the balance of payments deficits without a correction in monetary policy during that period. And the third stylized fact that I want to present to you is actually Fitch ratings. And all in monetary economics and of a forward-looking opinion on the relative ability of the country to meet the financial obligations or commitments, basically. And you can see here from 2015, it was BB minus, and then it was downgraded to B plus in December 2015, and November 2018, it was further downgraded to B, and then August 2020, it was downgraded to B minus. And then now it is actually the restricted default stage in June 2022. Basically, so that policymakers in the Treasury, fiscal and monetary policy authorities should have observed these trends. And this graph shows that the country was heading towards a possible currency crisis or a rising out of a debt default, and also a balance of payments, basically a balance of payments crisis. This is a third stylized fact that I want to present to you. Then let us look at the fourth one, the timeline of the things that happen, certain early warnings that you have as in addition to what I mentioned. In April 2020, the Fitch downgraded Sri Lanka's credit rating to B minus, but what is the response of the Central Bank of Sri Lanka? It has responded with a counter argument and a unilateral rejection of the downgrade. And 2020 November, Fitch downgraded Sri Lanka's credit rating to CCC. Central Bank actually responded similarly. And 2021 September, CBSL reinforced the hard peg of $1 to 203 overnight. Actually, this is done without actually preparing for the grounds for the hard peg. And actually, at the time of this policy of adopting a hard peg of rupee-dollar exchange rate, banking system was actually selling dollars to about 130 rupees per dollar. So that it was a 13% appreciation of the dollar that was done in 2020. And you know the implications of this on reserves of the country. And November 2021, fiscal budget was overestimated and seemed to assume 22 2022 dollar revenue from tourism and worker remittances would rebound to pre-COVID levels, but it did not materialize basically. And 2021 December, which again downgraded Sri Lanka's credit rating to CC, Central Bank actually responded similarly. And February 2022, IMF actually informed that Sri Lanka's debt is unsustainable. And then we know in March, Central Bank of Sri Lanka really removed the currency peg overnight, which was $1 to 203 rupees, without preparing the ground for a soft landing of the rupee. Basically, is a sudden so that rupee depreciated by about 60% during 2 weeks. And April, we know central bank suspended, the government suspended the external debt payments, and in effect, it was a and also you can see the right-hand side graph. This is a very important chart that we show. July 2021, this Bloomberg's risk analysis has shown default probability in countries, in Asian countries. You can see Sri Lanka 27.9% default possibility, and even it is worse than the Papua New Guinea or Mongolia, basically. And I would say that the monetary and fiscal authorities have ignored these important early warnings of a possible balance of payments crisis, even though these are very credible international statistics that any financial institution, monetary institution, or fiscal institutions would actually rely on in taking policy decisions. And then another fact that I want to show you is actually leaping towards the foreign exchange crunch. The actually loss of expected foreign exchange receipts due to various reasons. We all know that in November 2019, the Treasury or the Finance Ministry slashed in taxes, including near halving of VAT, helps dry up government revenue despite expert warnings of high debt obligations. And then we observe from 2020 March to 2022, Sri Lanka has lost about $4 billion of yearly currency influx via tourism and crippled hospitality depending economy due to the pandemic. And then in 2021, foreign workers' remittances, which is a major source of foreign exchange in Sri Lanka, has dropped by 22.7%. And in January 2022, forex reserves falls to actually 2.3 billion, but the usable amount was about 500 million in January 2022. And then you see inflation has risen, and February we see actually all these things are happening, including the possible import crunch and servicing problems of imports and all. You can see this is another stylized fact that we want to show you what happened to the reserves. And you can see actually reserves in Sri Lanka has never been in a good area since about 2014. If you look at 2014, it was about only 27% of currency in the foreign reserves. Actually, the 47% was actually foreign portfolio investment, and 27% was swaps. Swaps in Sri Lanka are basically not necessarily swaps, even though they are called swaps. They are credit lines, basically. So therefore, and then you look at from 2017 to actually early 2020, during that period, the reserve position, which has especially currency reserve position, has improved a lot. But then you see 2021, 2022, dipping the currency reserves. Now, these are actually in 2021, 2022 early. These are actually nominal reserves. They are not any meaningful reserves because these are swaps that you have mainly. Only 2% currency reserves that could have been used. And then we know that in April, Finance Minister informed the Parliament they have only 50 million usable reserves. And then Kumaraswamy in a seminar actually expressed that Sri Lanka's reserves have actually gone towards almost zero. And then these are the stylized facts. Then look at this one. Any central bank or any monetary authority should be mindful of actually the reserve adequacy at any point of time. This is a remarkable thing that we show. And we all know that reserve adequacy rule 1 that is used around the world central bank, the country should maintain reserves of the equivalent of 3 months of imports. And we know that in 2020, towards the end of 2020, Sri Lanka lost this possibility. And you can see in by 2021 January, Sri Lanka's imports actually started to go below 3 months imports. And this descending, you can see how it was becoming unstable. And the amount of reserves less than 3 months of imports is associated with a greater incidence and depth of finance balance of payments crisis normally as a standard practice. And the second major rule that all of us are using in determining reserve adequacy is actually short-term outflows to reserves, basically. And the country actually should hold reserves covering 100% of short-term debt normally at any given point of time. But a smaller reserve to short-term debt ratio is associated with a greater incidence. And you can see it was also happened towards the end of 2020 and early the reserve inadequacy actually starts towards the end of 2020, not in 2021. So this graph basically shows that in end of 2020, Sri Lanka has started to face a situation where the reserves are not actually sufficient to meet any external obligation in relation to short-term debt or other ones, basically. And then what happened to reserves? If you look at one question that you might pose actually, whether COVID-19 pandemic was the reason for the depletion of reserves in Sri Lanka. But you can see in the right top left chart, basically Sri Lanka's reserves have declined by 79% from 2019, end of 2019 to end of 2021, while all the other Asian countries' reserves actually have increased by, for example, Bangladesh by 41%, even Nepal by 4%. So therefore, they also face the similar situation of COVID-19 pandemic, but it appears that it is not the COVID-19 pandemic alone that has actually affected this, but something else. Then you go to the right-hand side graph, which clearly shows that it is actually the monetary policy related matter. Currency gold reserves were sold to maintain hard peg at $1 to 203 rupees, and reserves were used to service foreign sovereign debt, and reserves were also used to finance imports towards the end of, especially early January, early 2022 and later part of that. So these numbers basically show you it is a very special case where central bank use sterilization as a strategy. In the sterilization, what happens is that you are compelled to sell dollars or foreign currencies to maintain the exchange rate. And in order to maintain the domestic liquidity, you have to print money and put the money into the economy. Normally, if you want to stabilize this, what should happen is that you should actually sell dollars and take the money out from the economy so that you can contain inflation. When you do both, then on the one hand, reserves depleting, on the other hand, the inflationary actions are taken. Basically, I am not actually criticizing this. This is what basically has happened. By 2021 Q1, Sri Lanka ran out of forex reserves, as we all know. Forex reserves were negligible, receipts were negligible, that resulting in debt default and an import crunch. All of us know this, which in monetary finance jargon is a currency or a BOP crisis. And Sri Lanka appears to have got into this mess by following Keynesian fiscal expansions and accommodative monetary expansions following the unscientific and disastrous modern monetary theory fallacy. I would call it not a fallacy, but it's a theory, but it's basically a fallacy. And why did policymakers fail to anticipate the BOP crisis even though forecasting helps? For instance, a number of economists have been able to forecast the global financial crisis of 2008, especially Nauro Rubini, 2006, Pettifer in 2006, Keene in 2006, and various others, including Raghuram Rajan, one of the prominent economists, predicted. But mainstream institutes and central bank actually ignored them basically. And then, but with regard to Sri Lanka, you can see, we see a study by Dayaratna et al. In 2011 has identified in a comprehensive macroeconomic, comprehensive econometric study that the budget deficit has actually raised the current account deficit of Sri Lanka, and they were actually recommending to avoid depreciation of the exchange rates and the BOP crisis. The government needs to introduce fiscal adjustments measures. And then in 2014, one of our studies, we have found actually that Sri Lanka's external debt was already unsustainable, and we were heading towards debt default or a possible currency crisis. And in 2012, this W. Vinayagathasan, a prominent monetary economist, actually in an analysis explained that Sri Lanka was already in a fiscal cliff, which is a situation where you reach the debt limits or borrowing limits and you are not able to finance your expenditure and also honor your debt. This is actually not recently, but far long ahead. And he was warning the government that do not expand the government, do not expand the expenditure, but you need to have fiscal discipline. And in 2020, actually, Colombo, one of the prominent, again, monetary economists, has warned that worshipping MMT is likely to magnify economic instability. But we see that the most up-to-date macroeconomic theories, but it appears to us that the monetary and fiscal authorities have not actually pay heed to these the burning signals. And we all know that forecasting helps, but we need to remember that forecasting is not astrology. You should not think that somebody forecasted something, it did not happen. Actually, it gives policymakers an opportunity to understand the macroeconomic forces that they will have to deal with in the near future in their efforts for stabilization and growth. So therefore, what the role of forecasting is to actually help the policymakers to understand what kind of forces that they will have to deal with in the future. And based on these stylized facts and our observations, basically without making any conclusion about what happened, I am going to pose these questions. Were there early warnings for the currency crisis by 2019? What is the impact of the Easter Sunday terror attack on the economy? What is the impact of the COVID-19 lockdowns on the economy? And what is the impact of fiscal and monetary policy shocks since 2019 Q4 on the economy? And then finally, what do macroeconomic forecasts indicate about the economic recovery? And basically what we are going to do is we will use actually component-driven quarterly Bayesian vector autoregression approach, a model to actually answer to these questions. And what I already presented were certain stylized facts, which actually tell certain signals or information about what happened to make a conclusion, but we will rely on the model to make a
Before explaining the methodology, let me explain why we choose Bayesian VR model and why we do the forecasting. So they are also anticipating macroeconomic trouble. So in manner which the government of Sri Lanka has handled the macroeconomic policy in 2020 and 2001 demonstrate the fact that the policy making bodies have failed to predict and prepare for the foreign exchange crunch and the resulting economic meltdown in 2022. Economic forecasts are seriously considered by the policy-making bodies in modern days in determining the macroeconomic policy, even if they do not provide certain outcomes. The recent development in macroeconomics, econometrics, and ICT have shown that the leading macroeconomic variable in the business cycle help economists to provide an approximate forecast of the behavior of the economy in the short term. So as initiated by the Hiram Cross in 1969, the macroeconomic forecasting emerged in the 1960s with the attempt by the Royal Economic Society of the UK that embarked on macroeconomic forecasting as a new economic activity. So 1970s and the 1980s, series of rigorous work by number of economists, including some names are mentioned here, has made a significant contribution to the modeling approach of macroeconomic forecasting. A series of innovative econometric modeling evolved by Sim in 1980s and others have shown that macroeconomic forecasting is possible, at least in the short run. So recently, many researchers have adopted Bayesian vector autoregressive as a benchmark model to analyze the impact of internal and external shocks on macroeconomic variable. So those are the names. Some of them, they have used the Bayesian VR. With the development of many sophisticated macroeconomic forecasting models and the ICT revolution, public and private institutions make a short-term economic forecast that hide the direction of economic and business decisions. So those are the reasons that we do macroeconomic forecasting and we choose the Bayesian vector autoregressive model as a tools to forecast the macroeconomic variable. Variables that we have used in this study are, we have used 19 variable, macroeconomic variable, especially GDP growth rate, inflation, unemployment, public debt, exchange rate, budget deficit, buying rate, treasury bill rate, domestic credit, balance of payment, money supply, international reserve and liquidity, export, import, remittances, tourist arrival, rate deficit, world crude oil price, and world natural gas price. The abbreviation and the definition and the data sources are given here, so you can see that one. So the model specification, following the pioneering work by Sim 1980s and some other studies, we used Bayesian vector autoregressive model to carry out the macroeconomic forecasting. The basic baseline VR model as given here. Here YT is the 19/1 vector of endogenous variable. YT minus I is the lag value of the YT and UT is the random error term. In the equation 1, to see the impact of regime changes, we have included a dummy variable with equation 1. Here dummy variable is denoted by RC, RCJ, J starting from 1 to 4. There are 4 regime changes we are in our data set include. Regime 1 is the Chandrika period, but we are not covering the full period of Chandrika period because we starting the data period is 2001. That we started the 2000 due to 3 reasons. So one is the drastic change of the pace and amount of sovereign debt accumulation in Sri Lanka began in this period. Second, Sri Lanka started to practice flexible exchange rate system with some form of foreign exchange intervention in the domestic foreign exchange market. That significantly affected the foreign exchange rates, reserve position and the country and the ability to manage the external sector. Third one, there was a negative economic growth in 2001, that is 1.545. That is the reason we started 2001 as a starting period. Therefore, only some period of the period is starting here. So in the second period, mind the period 2005 to 2014 quarter 4, and Maitri period 2015 quarter 1 to 2019 quarter 4, and the fourth one, period 2020 quarter 1 to now. In the second model, we are estimating the impact of Easter Sunday terror attack by including the dummy variable, which EST, that take the value 1 if we are greater than or equal to 2019 quarter 2, because the terror attack was happened in April. Therefore, we take as a quarter 2. Third one, we are estimating the impact of COVID-19 pandemic on macroeconomic variable. So where we include the equation 1, COVID as a dummy, then COVID take value 1 if year started greater than 2020 quarter 1. Fourth one, we are estimating the impact of expansionary monetary and the fiscal policy, but we include both as a one dummy because both expansionary policy was happening in the same period. Therefore, to avoid the multi-collineate issues, we use as a one dummy, which is MBFB take the value 1 if year greater than equal to 2019 quarter 4, otherwise 0. When we are estimating the Bayesian VR, we should carefully choose the prior information because there are many prior information. Then we should choose the correct prior information according to the Coop and Coroblis. Say that if our model has a several variables, then prior should be carefully chosen. Otherwise, predicted standard deviation could be large. And therefore, following the much of literatures, we use Minnesota type prior in this estimation. So when we come to the estimation, we estimated the equation 1, our basic model, baseline ER, using the 2 different sample period. The sample period 1 include 2001 quarter 1 to 2018 quarter 4. By estimating this, we are examining where they are early warning by 2019. Quarter 1 to 2020 quarter 4. In using this sample, we are checking all those 4 impact. One is how did macroeconomic variable interact under different regimes? That is represented by equation 1.1. Also, we examine the impact of Easter Sunday terror attack, that is represented by equation 1.2, and examine the impact of COVID-19 lockdown on macroeconomic variable, which is represented by equation 1.3, and examine the impact of fiscal and monetary policy shocks, that is represented by equation 1.4. When we come to the forecasting, as the model are geared towards capturing complex dynamic interlinkage in the macroeconomic variable, we do not focus on the predicted variable in any specific quarter age periods in the future, but we want to assess the model capability to show variable direction over range of quarters. Therefore, for the short run, we produce iterated forecast for the worst 12 period ahead. Thus, for the worst sample period, that is using the 2001 to 2018 data, we forecasted from 2019 quarter 1 to 2020 quarter 4. And using the second sample period, that is using the 2001 to 2020 quarter 4 data, we forecasted from 2021 to 2023 quarter 4. And also, using the longer period data will not provide the unbiased estimation. Therefore, we shortened the estimation period from the good governance period to until now, that is 2015 to 20, and forecasted from 2021 to 2013 quarter 4. When we come to the macroeconomic relations and impact and performance, these are the summary statistic of the variable that we have used. So I am skipping this part. So next we will look at how macroeconomic variable interact under the different regime. So here we used Andrika period RC1 as a reference category, that is omitted group, and then we include the RC2, Mahinda period and Maitri period, and the RC4 Sota period. So when we look at the GDP growth, the Mahinda period and the Sota period does not have significant impact on GDP growth. However, Maitri period has a positive impact on the growth. When it comes to the budget deficit, none of the regime do not have significant impact on the budget deficit. However, budget deficit, the sign, it is increasing according to the sign. So when Mahinda period, it is 0.474. Then Maitri period, it has increased as a 0.663. And for that period, it is increased more than those two became, that is 0.947. And when it's come to the balance of payment, how the regime changes affect the balance of payment. Balance of payment deficit has increased. Mahinda period and the Maitri period does not have significant impact, even though it has a negative sign. But the Kota period has increased drastically and with a significant. So there was a early warning. Even the Mahinda period also is a negative, and 398. The coefficient is 398.4. There was As in the stylized fact, we have, as we explained, here also, even before the 2018 also, there was a early warning. And bank rate, minor period and Maitri period do not have significant impact on the bank rate, but the Hota period has a negative impact. Domestic credit. So domestic credit, minor period does not have significant impact, but the Maitri period and the Hota period has a significant impact, and also it is increasing when the regime changes. So in Maitri period, it's at 3,364.5, but in the Hota period, it's 8,740.4. When it comes to the exchange rate, none of the regime has significant impact on the exchange rate, but the Hota period, Mahinda period, it was positive, other regime, it was a negative. Export also, none of the regime has significant impact on export, but Mahinda and the Maitri period export is positive. However, Hota period is a negative because there was the export is limited in this regime. Import also, none of the regime has significant impact on import, but Mahinda and the Maitri period import was positive. Hota period was negative because there was a import restriction. Inflation. Mahinda period inflation was negative, but not significant. Maitri period inflation is positive, also not significant, but we can see in Hota period inflation increases 3 times more than the Maitri period. So that also in the Hota period inflation, increase in inflation is statistically significant. When it comes to the money supply, none of the regime has significant impact on money supply, but the Mahinda and the Maitri period it was negative, but in Hota period it was positive, and it is 8,354. The coefficient is 8,354.5 because this is maybe the due to the money printing. Public debt. Mahinda period it was equally significant and negative. Then Maitri period it is decreased, and the Mahinda period but not significant. But in the public debt was increased in the Hota period with the statistically significant. Remittances, Mahinda and Maitri period do not have significant impact, and Hota period has a significant and positive impact on remittances. Reserve, none of the regime has significant impact on the reserve. However, in the Mahinda period it was negative. Mahinda and the Maitri period it was negative. Hota period it was positive. And tourist arrival, none of the variable has significant impact on the tourist arrival. However, in Mahinda period it was a negative. So, tourist arrival, none of the regime has significant impact on the tourist arrival. However, in Mahinda period the tourist arrival came to negative, but in Maitri period and the Hota period it is positive, and also Hota period is more than the Maitri period. The treasury bill rate, Mahinda period and the Maitri period has significant impact on treasury bill rate and also positive, but the Hota period does not have significant impact on it. The rate benefit, none of the variable has significant, none of the regime has significant impact on the rate deficit. However, in the rate deficit was positive in Mahinda period, but it came to reduce negative in the Maitri period. Somehow they have managed to decrease the rate deficit, but in Hota period again it was increased. When unemployment, Mahinda and the Maitri period has negative impact on the unemployment and also significant. Even though Hota period has significant impact, but it is negative impact, but which is not statistically significant. Next, we will explain the highlight. So next, we will explain the estimation results of the second sample period 2001 to 2020. So when we look at the GDP equation, the only budget deficit has GDP equation, GDP growth and budget deficit has significant impact. Budget deficit and the inflation has significant impact on GDP, and budget deficit equation, GDP growth. GDP growth and remittances has significant impact on budget deficit. And then the balance of payment equation, only remittances has significant impact. Then bank rate, treasury bill rate has significant impact on the bank rate. Domestic credit, inflation and the money supply has significant impact on. And in the exchange rate, GDP growth rate, domestic credit, and the treasury bill rate has significant impact. Positive, budget deficit, inflation, and world crude oil price has negative impact. Export, in the export equation, none of the variable has significant impact on it. Then import equation, budget deficit and money supply has positive impact, while public debt has a negative impact. In the import equation, so inflation, treasury bill rate has positive impact, and others do not have significant impact on the inflation. Money supply, domestic credit has positive impact, treasury bill rate has negative impact on the money supply, and public debt, reserve and unemployment has positive impact, GDP and exchange rate has negative impact. When it comes to the remittances, public debt, reserve has positive impact on the remittances, and the reserve, GDP growth rate and the remittances have positive impact, while budget deficit has negative impact. Tourist arrival, budget deficit has positive impact, and the crude oil price has negative impact. Then treasury bill rate, inflation has positive impact, while remittances have negative impact. Rate deficit, only exchange rate has positive impact, and unemployment rate, public budget deficit and the public debt has a positive impact on exchange rate.
Thank you, Dr. Vinayagathasan. So this is about the macroeconomic relations and the performance. So our estimation horizon is from 2001 quarter 1 to 2020 quarter 4. So the results. So let's see variable by variable. First, the GDP growth, we can see that there is a negative growth rate, negative trend going to be forecasted there. We can see that when we get the best case or the worst case scenario, the situation would be same. And for the budget deficit, we can say that there would be further widening gap between government revenue and government expenditure. That is, the budget deficit going to be further widening during the coming periods. And about the balance of payment, it shows how much deficit there, that it could be that it is going to be continuing in the similar way. If we take the worst case scenario, we can see that the budget, the balance of payment deficit going to be further deepened there. About the bank rate, we can say that bank rate is going to be slightly declined in the coming period. The domestic credit, as shown here, the forecasting period that it's going to be significantly increased. When it comes to the exchange rate, we can see that the Sri Lankan rupee is going to be further depreciated against the US dollar and other foreign currencies. There, we need to note that our estimation is just from 2001 to 2020. So therefore, the intervention done by the central bank in the form of currency peg from 2021 September to 2022 March, and after that, when they release that peg, so that impact is not reflected in our data. That's why if you carefully see, forecasted exchange rate is somewhat around 240. So that's the reason for that type of forecast there. When it comes to the exports, we can say that on average, that exports would be just on the same range. But on the worst case scenario, if it happens, then that exports going to be reduced significantly. About imports, we can say that there is slightly improved, that is that imports going to be little bit reduced in the coming period. But in the worst case scenario, we can see that it's going to be significantly increased. About forecasting on inflation, we can say that inflation, according to our particular estimation and the forecasting for this period, that it's going to be slightly decreased. But again, the recent dynamics that has happened on inflation, that couldn't be reflected here because our estimation period is limited to up to 2020. And for the money supply, we can say that there is significant increase in the money supply. And again, a troubling sign can be observed here on public debt. So we can say that when we get the best case or the worst case in all three aspects, the public debt is going to be increased significantly in the coming period. In the worst case scenario, it could be even more than 130% of the GDP value. About the remittances, here we can say that based on our estimation that remittances going to be somewhat in similar range in the coming period. About international or foreign reserves, we can say that there would be slight increase in the reserves. However, when we take the worst case scenario, there seems to be a significant decline. And about the tourist arrivals, we can say that there is in the coming period a significant increase could be observed. About the treasury bill rate, we can say that there is kind of a decline in the treasury bill rate could be expected there. So the projected value for trade deficit, we can say that the trade deficit is going to be widened there. However, it is the Sri Lanka economy is going to experience same trade deficit there in the coming period also. With respect to unemployment, we can say that in the coming period, unemployment is going to be steadily increased here. So it is proven by the both worst case and the best case scenario also. This is about the just forecasting based on the period, the full sample period from 2001 to 2020. So all as a summary, we can say that some of these variables indicate that there won't be a recovery in the coming period as a quick recovery. Next, one important aspect of our research is that we want to find out whether there were significant early warning by 2019. So, since it is important, we used that in-sample forecasting method to find out this, whether there were significant early warning visible by 2019. So, our sample period estimation horizon was from 2001 to 2018 Q4, and from there onward, from 2019 first quarter to 2021 last quarter, we did the in-sample forecasting. So here, the blue line shows the actual value for that period, while this dashed line shows the average value for the forecasted value, and the red dash value shows the upper and the lower bound for that period forecasting. That is basically the best case and the worst case scenarios. So let's take GDP growth. When we take the GDP growth, we can see that it is by 2019, from there onward, we can see there is a significant decline in the GDP growth. So this is an important early warning. The reason is that when we take the actual rate also, the GDP growth started to be declined there from 2019 onward. Even when we take upper value and the lower value, the best case and the worst case scenario, we can see that GDP growth rate was in a declining way. So let's forget about the Easter Sunday attack. Let's forget about the COVID-19 pandemic. Even by 2019, that GDP growth rate was going to be a declining way. This is a very important early warning that we may have missed that. About budget deficit, we can say that it was going to be in the same range. However, when it comes to the worst case, we can see that there's a widening fiscal gap. But actual value shows that a sharp increase in the budget deficit during that period. Again, with the balance of payment, it shows another significant early warning. That is, with the balance of payment deficit, we can see that when we take the worst case scenario, it was going to be further deficit gap. And the actual values also show somewhat similar figure there. When it comes to the bank rate, we can see that bank rate was going to be in the similar position during that period in the sample forecasting. However, the actual value shows a sharp decline here. The reason is that during that time, the expansionary monetary policy was implemented. About the domestic credit growth, we can say that it was that actual value and the sample forecasting both were in the similar line and similar range, so it was going to be increased. About the exchange rate, it again shows another early warning. That is, so from the in-sample forecasting, we can say that exchange rate was going to be that the value was going to be increased. That is, Sri Lankan rupee was going to be depreciated against the US dollar here. So the actual value also show the similar situation here. About the exports, we can say that another early warning. That is, when it comes to the worst case scenario, we can see that it was going to be decreased. And the actual values also show somewhat similar fluctuation there. About the imports, similar situation we can observe that imports were about to be in the same range, and the worst case shows somewhat decline there, and the actual values also show similar situation. When it comes to the inflationary forecast, the in-sample forecast shows that there was a kind of increase, a rise in inflation in the coming period. The actual value also shows the same way. So this again proved that by 2019, the economy was not in a healthy situation. So this is again shows kind of early warning. Money supply was also going to be increased, and the actual value also shows the similar way. Another early warning could be visible with the public debt. Here we can see that worst case as well as the best case scenario, the average values of the forecasting here was that public debt as a percentage of GDP was going to be increased. Similarly, the actual value shows a significant increase there with the public debt. So this is again shows that our economy was not in the healthy trajectory there. With regard to foreign remittances, we can see that there was a slight decline starting from 2019 onward. Even when we forget about the COVID-19 pandemic, during which we say that we lost certain amount of foreign remittances due to that impact. However, the foreign remittances was going to be declined starting from 2019 onward. So the actual figures also confirm the same situation. Foreign reserves, we can say that it shows similar situation there, that reserves going to be declined and the actual value also fluctuate nearby. With regard to tourist arrivals, we can see that tourist arrival was projected to be increased. However, actual values shows fluctuation there as a result of the COVID-19 pandemic and the Easter Sunday terror attack. With regard to treasury bill ratio, we can say that it was projected to be increased. However, due to the expansionary monetary policy, we can say that the actual value was declined there. With regard to trade deficit, we can say that it was in a deficit there, trade deficit, and the actual value also fluctuate within that range. When it comes to the unemployment, we can see that unemployment was also about to be increased in sample forecasting, as well as the actual value also show the similar situation there. So all in all, we can say that there are several variables that show some significant early warning about this crisis. Even when we forget about the Easter Sunday terror attack as well as the COVID-19 pandemic, that root cause of this crisis was visible by 2019. Many variables were in the distress zone. So if we have, in a way, we could have avoided this situation by adopting proper fiscal and monetary discipline, but it was not the case. Next, we discuss about the impact of Easter Sunday terror attack. Here, we use Easter Sunday dummy variable there, as we explained in the methodology part. We use this dummy variable to capture the significant, whether there was significant impact due to this Easter Sunday attack. Here we can see that some variables are significant in this particular model. So here we can see budget deficit, bank rate, public debt weakly significant, as well as remittances and tourist arrivals significantly decreased during that due to that attack, as well as treasury bill rate, there was a decline. So likewise, we can say that there was some significant impact due to the Easter Sunday attack here, according to our model estimations. Next, we wanted to see whether what are the impact of COVID-19 lockdowns on our economy. For that also, again, we use a separate dummy as we illustrated in the methodology part. Here, the COVID-19 pandemic was represented with this, impact was represented by this COVID dummy there. We can see that several variables got affected. GDP growth, negative, balance of payment, widened deficit, bank rate, domestic credit, exports and imports both, inflation, weakly significant, public debt, highly statistically significant, remittances and reserves. So likewise, we can say that there was some impact of the COVID-19 pandemic on our economy. Next, we want to find out the impact of fiscal and monetary policy shocks since 2019. So that again, we use a dummy variable. So that MPFP dummy variable, there we wanted to capture the impact of expansionary monetary and fiscal policy implemented after or within the Gotabaya Rajapaksa regime. So there we can see that some of the variables are statistically significant, like GDP growth, bank rate, domestic credit, exports, public debt, and remittances. Likewise, we can say that the impact of expansionary monetary and fiscal policy also visible there in our model. So altogether, what we can say about the analysis on different dummies is actually that the root cause of this particular BOP crisis, as it was emerging by 2019, and on the top of that, we had this Easter Sunday attack, and then COVID-19 pandemic, and finally the wrong choices on expansionary monetary and fiscal policy. So all these three shocks aggravated that BOP crisis into a severe situation. Next, as the final part of our presentation, we want to present about the macroeconomic forecast until 2023 quarter 4. There, as we illustrated in our methodology part, we chose a short estimation horizon from 2015 to 2020 last quarter. And then we forecast for 2021 first quarter to 2023 last quarter. So here in GDP growth, we can say that in the coming period, as we earlier presented, that it is going to be a negative growth. It shows that there won't be a sudden recovery in the GDP growth. About the budget deficit, we can say that that budget deficit is going to be further widened in the coming period. And in the worst case, we can say that it would be a severe situation there with regard to budget deficit. And if we couldn't, or if we don't adopt proper mechanism there to address this situation, then it would create a huge burden on our economy. With regard to balance of payment, we can say that balance of payment, the deficit would be continue in the coming period. And in the worst case, it could be severe with the balance of payment deficit crisis. And about the bank rate, we can say that the bank rate is going to be slightly declined based on our projection for the coming period. Moving on to the forecast on domestic credit, we can say that domestic credit is going to be increased. Similar situation we can see for the exchange rate also. That is, the Sri Lankan rupee is going to be depreciated against the foreign currencies in the coming period also. With respect to exports, we can say that exports going to be remain in the similar situation or in the same range, but in the worst case that it would even decline into very less amount here. With regard to import, we can say that there could be a slight decline we can observe. However, in the best case scenario, it would significantly decline. In the worst case, it would increase further. With respect to inflation, we can see that there is a steady increase in the inflation also. And also with the money supply, we can say that money supply also going to be increased significantly in the coming period. With respect to public debt, we can say that public debt is going to be increased in the coming period. So this again shows a troubling sign here, because even when we get the worst case scenario, that projected public debt would be even more than 120% of the GDP value. With regard to remittances, we can say that remittances going to be in somewhat little bit decline in the coming period. In the worst case scenario, that remittances going to be declined further there. That is, that the inflow of remittances into the country going to be declined further, but that's the worst case scenario. With respect to international reserves here, we can say that the reserves going to be remain similar situation. However, the worst case that it would be declined significantly. And with respect to tourist arrivals, we can say that tourist arrivals also going to be in the similar situation. But in the worst case, it would be declined significantly. With respect to treasury bill ratio, treasury bill rate, we can say that it is going to be slightly declined there. And for the trade balance, we can say that the forecasting values shows that there is a significant deficit in the trade balance in the coming period also. Finally, with the unemployment, we can say that expected values shows that unemployment is going to be increased. If we take the worst case scenario, we can say that unemployment is going to be increased by even for 8% like that. So these are the macroeconomic forecast for the coming period. Next, we have the concluding remarks. To deliver that, I would like to invite Professor O.G. Dayaratna.
Okay, thank you, Dr. Thushari. I think we have come towards the end of this presentation. I think I will summarize the results, even though some results might not have been clear to you. Basically, a few questions we raised at the beginning. One, were there early warnings for the crisis by 2019? Our model estimates show that there were significant early warnings by 2019. These variables show it: GDP growth rate, BOP, balance of payments, exports, inflation, public debt, remittances, foreign reserves, trade deficit, and unemployment variables were already in the distress zone towards the end of 2019, and have shown significant signs of a looming BOP crisis when you analyze the signs and the size of the coefficients. And I would say that these early warnings have been might have been ignored by the policymakers, and the actions that actually in this point, the only possible fiscal and monetary policy options were to actually contain monetary and fiscal expansion. There is no other policy option that you can suggest, because this shows these results actually show a similar situation to the iconic Latin American debt crisis that we observed in 1980. Sri Lanka situation is very, very similar to that. So that I think at a time where you should have, so that it's actually by 2020, Sri Lanka could not actually have taken actions to actually rapid economic growth, because it was not possible. What we should have done is actually not through budgetary expansion and monetary expansions, a rapid economic growth target, but a containment of fiscal and monetary policies. This is what we find in the data that we have. And then the Easter Sunday terror attack has had some impact on the macroeconomic variables, and the COVID-19 lockdowns also have some negative impacts on the GDP growth rate, exports, and also certain positive impacts on the other variables. But the most important thing why we did this one, we wanted to find out actually there were early warnings, and then whether it was this Easter Sunday shock and the COVID-19 shock that contributed to the sudden collapse of that. But we find that expansionary fiscal policy by cutting down taxes and raising expenditure, and accommodative expansionary monetary policy by expanding money supply, actually have contributed significantly to actually, especially negative contribution to growth rate, and also other variables, exports, etc. So that this is actually, when you look at overall about the analysis of the data, what our model shows is actually is a classic case. And you can see now that BOP crisis, our results show that BOP crisis, its balance of payments crisis has already spilled over to the real sectors. So therefore, it's no longer a balance of payments crisis or a currency crisis. It is already an economic crisis that we have our data show. So in this analysis, in conclusion, we can say this is a classic case of crash landing of a deficit fuel Keynesian development flight. It was actually the textbook example of crashing of an economy by adopting expansionary monetary policy and expansionary fiscal policy over and above the sustainable level of debt and others. And then if you look at the macroeconomic forecast, actually, as the data is not, we use quarterly data, since data is not available for the 2022 quarter one, we had to rely on the 2022 end of quarter four data. But we find actually that GDP growth rate seems to remain in the negative territory, even in the best case scenario for a few more quarters, which means the recovery is not going to be V-shaped. is going to be remaining for a particular, the slump is going to remain for a particular period. And if possible, rebound or turnaround is possible towards the end of 2023 or early 2024, according to our data, according to the current macroeconomic environment. So that in all indications, Sri Lanka's recovery will not take V-shape. The prospect of a quick economic recovery is gloomy under the prevailing macroeconomic policy environment. I want to highlight this. If you change the macroeconomic environment, you can change these forecasts and achieve a better outcome. But if the current or the macroeconomic environment that prevailed prior to March 2022, then you would have this outcome possibly. And the forecast results are also indicative of the fact that the comprehensive macroeconomic policy framework aim at stabilizing the balance of payments, exchange rates, and inflation, and also building adequate reserves along with the recommencement of debt servicing will be vital for augmenting economic recovery. So that what this says is that you need a very comprehensive macroeconomic framework, policy framework, which includes fiscal discipline, monetary discipline, and also building confidence in the investors, private sector, and foreign investors, as well as others, so that you can actually make, so that what these forecasts actually tell us is not to scare anybody, but we should actually understand the signals given by these forecasts and act counter factually or actually in the opposite way to actually contain these things. And also we can see that there is no, you need to understand that fiscal expansion or monetary expansion through a Keynesian type policy intervention will not solve the current crisis. It will actually aggravate it. So that what we have is only supply side policies, not demand side. Demand side, aggregate demand management, containment of demand, and containment of fiscal expenditure, revenue, increase in the tax and other revenues, and also containing monetary expansion is the only option. But you need significant structural and policy reforms urgently, especially in the supply side area, to stimulate private sector-led economic growth, because government actions have come to a limit because of the debt reaching the limit, and the servicing of debt has become almost impossible. And also inflation has actually closely reached to the hyperinflation level. Inflation appears to have already reached to the hyperinflation level, and also other variables show very, very distress signs in the overall. So that in conclusion, economic recovery, turnaround and returning to normalcy is possible between 4 to 12 quarters if the right policies are implemented only. If we go with the economic mayhem and lack of clarity of the policy and the synergy between various policies, and we are going to actually experience the similar difficulties in the next few quarters also. So with that, I think I would like to conclude the presentation. I would like to thank Dr. Ganeshmoorthy for graciously agreeing to moderate the presentation, and also Sri Lanka Economic Association for giving us this opportunity. And I would like to again reiterate that this is an ongoing work, and we wanted to present the preliminary results to a wider audience to actually understand certain overall things that are happening in the economy. Thank you very much.
Okay, great. So we have listened a very powerful presentation with a lot of information from the three presenters. And I would like to thank them for guiding us through the troubled quarters and troubled seas, and having shown us the major issues and problems in the economy, the early warning signs, and also the failure from the policymakers to recognize these early warning signs and respond to those early warning signs, rather than citing COVID-19 and the East terror attack as the root cause of this pandemic and crisis situation. So it's a political economy failure that brought us into this chaotic situation, and there is no quick recovery from this mess. So 1.5 hours has been passed, but we couldn't realize the time has been gone that level. Without wasting your time, and I would like to open the floor for a questioning and answer session. You may ask questions, make it very short and sweet. If you want to ask the question to a particular presenter, you may do so, or otherwise, if you can post the question to the entire panel, that would be also welcome. And one more thing, that today's presentation will be, in a way that will be taken by the SLEA, and it will be made available for the wider audience in a appropriate, platform.
Yes, shall I comment on certain questions that are there in the chat box first, and then?
Yeah.
Yes.
Yeah.
Yes, one question that has been raised is actually whether this Easter Sunday and COVID-19, what we were saying was that there were only warning signs for a possible currency crisis by early 2020, but the aggravation and the complete collapse of that is basically not due to those shocks, so COVID-19 or Easter Sunday thing. It is basically, we can see fiscal and monetary policy failure, basically. If you, for example, think of a situation where you adopted right monetary policies and fiscal policies, which were actually basically containment, fiscal and monetary containment. There is no other policy option that you had. And if you did that, then even with the COVID-19 pandemic, we would not have come to this grave situation. We would have had some problems, but we would have actually managed little bit or significantly better than what we actually experience now. That is one comment that we want to say. It is actually about the points raised. And also, I do not want to blame anybody for these policies. These are choices. Now, policymakers make choices, and they may make wrong choices. That is why I remember Jimmy Carter once said a long time ago, he wanted to find out one-arm economist. Because economists always give alternatives to a possible problem, alternative solutions, so that I would say that it may be a wrong, or the policy expectations or the policy choices have gone wrong, or misjudgment about something. And also, it is actually, somebody has asked whether the central bank and the treasury should have done these forecasts. Yes, it is the responsibility of the monetary and fiscal authorities to have their own comprehensive macroeconomic forecast to guide their decisions, because fiscal and monetary policy in financial and monetary sector, you cannot determine future policies based on the current or future variables without actually understanding what will happen, at least in the future, at least in the near future. So therefore, they are required to have comprehensive macroeconomic models. We know that central banks around the world are using comprehensive macroeconometric models to understand as well as forecast And finally, there is a question whether fiscal and monetary policy actions were followed by any country during the COVID-19 pandemic period. You cannot actually compare Sri Lanka's situation to a particular country, because as I already said, Sri Lanka was already facing a huge stock of sovereign debt. And already our budget deficit was very, very heavy. So therefore, what we were saying is that in such a situation, you have only fiscal containment and monetary containment as the option. And similar countries, if they have such situation, they would have done. But another country that did what we did was actually Pakistan. Pakistan was actually having these problems, and they were following expansionary and all policies. And you know that Pakistan is on the verge of collapse. Pakistan is on the verge of a currency crisis or a balance of payments crisis. They have been negotiating for a IMF bailouts, and they haven't agreed. And Laos is another country where the similar situations. And what we say is that actually when the macroeconomic variables show you certain signs, and we would have adopted a different policy than what we did. It was actually not possible to completely contain fiscal expansions because there were COVID-19 subsidy requirements and others, but still we could have tried certain policies that, and for example, one policy that we could have done, as Dr. Vinayagathasan ourselves and various people were saying, that we could have actually gone for debt restructuring and negotiation for a debt moratorium in early 2020, not now. If we did that, actually, you would have managed other things with debt restructuring and other things, and you could, and that is called basically pre-default, preemptive debt structuring. You don't done. What we have done now is we have defaulted our debt, and now we are negotiating for a further points. And yes, I think there is another question that whether we are aware of the reports of the central bank. Yes, we are aware of the central bank statements, central bank reports, and we have reports that the Central Bank of Sri Lanka was actually not expecting this dismal outcome in early 2022. They were not expecting that. And what they were saying was that they were rejecting the credit rating downgrading. They were relying on the modern monetary theory fallacy to actually inject more money into the economy. So therefore, I don't think central bank central bank reports actually do not show that in 2020 early quarter, whatever the published ones, that we are going to have this sovereign debt crisis, currency crisis, and also import crunch to this effect. What they have shown is that they will be managing them, and they were managing the reserves, they were managing other things basically. That's what I am aware, but I may not be aware of, we may not be aware of the certain reports that they have, but public domain ones, yes, we are. And another question is about what about CBSL confidential reports to government, and we are not aware of them. But what I can say is that what I know personally is that central bank and treasury and the other responsible people in the government, they have actually thought that they can manage this. They would have thought that they can manage this, and there will be no issue. So therefore, I think confidential reports I am not privy of, but I think what we know is that if the central bank had these predictions by 2020, now, for example, let me give you one example. Hard peg adopted in September 2020, and which is a serious policy mistake, because you see, when there is a pressure for exchange rate to further depreciate significantly, and you don't go for a hard peg, what you do is you actually adopt this thing called crawling peg, where you allow exchange rate to gradually depreciate with a time-bound framework, where then business and the others can predict the exchange rate. So the hard peg means that central bank had to sell dollars, sell currency to maintain hard peg. That was a wrong choice, because at a time when you have to actually adopt a crawling peg or a kind of a flexible, kind of a managed floating exchange rate, you go for a hard peg by appreciating the exchange rate by about 13%. That was a wrong choice. I don't think that they should have done at all. If they didn't do that, for example, this sterilized monetary actions, they could not take. They don't have to take that. Sterilized monetary actions, basically what they did was they were selling foreign currency to manage the hard peg. At the same time, to maintain the liquidity in the domestic financial system, they were printing money and putting them into the economy. That is, I think that is a big policy mistake.
So anyone want to make any other questions?
Yes, and there is a suggestion that 3 reports actually to tell you, I think our audience, if you carefully listen to Dr. W.A. Vijayawardana's writings and comments for the last 3-4 years, policymakers, he actually had been writing since 2020. He was saying in 2020 that definitely you have to restructure your debt. He was selling it. There were various specialists in the monetary area who were actually talking about taking actions that are but I think the policy actions actually did not actually, and also as economists, we publish various forecast macroeconomic studies. For example, you see, look at our study in 2014, Dr. Vijayawardana's study in 2012, and Professor Dayaratna study in 2011. They were already forecasting that they were already saying that Sri Lanka's foreign debt was unsustainable and the economy was on a fiscal cliff, which means that you have reached the credit limit, you cannot actually service your debt. And the policy that we can adopt is actually reforming the markets and actually let the markets work rather than inflating the government. I think since 2010-11, what we did was we have been inflating the government. And if you look at actual data here, there is a very serious crowding out of private economic activity as a result of expansion of the government. We didn't want to show that data, but we have found that private economic activity or private investment has very seriously crowded out by the expansion of fiscal policy and monetary expansions, basically. And I think the whatever it is, I don't want to personally blame anybody in the fiscal and monetary authorities, but I would basically, we would say that it was a wrong choice. Policy choices were actually not supported by historical trends or the forecasts. They were based on, I would say, too much of too bad politics. Some people think we were not actually politically sound in that. I would say that too much of too bad politics and towards the left of the political spectrum, not to the right of the political spectrum, and adopting Keynesian expansionism as a strategy to expand the government, and then thought that they can actually make the economy prosper. And that was, I think, the macroeconomic variables actually did not show that policy possibility by the 2020, basically. So I was actually addressing these. There were so many comments in the chat box. I think what Sri Lanka Economic Association is going to do is that one of their members, eminent members, will put this one into a newspaper article to understand, for the laymen to understand, basically. So that I think a newspaper article will be an outcome from this as a decision of the Sri Lanka Economic Association.
Great. I think your last point is very valid because the statistical numbers are very much difficult for a layman to understand. So these findings should be somehow amended to the layman's language, and especially in not in English but in Sinhala and Tamil languages, and put into the newspapers. And that's a great suggestion. I think the SLEA would do it in due course, and this message will go to the general public and see there were early warning signs before the pandemic comes and before the crisis comes, and the policy responses from the responsive authorities were not in par with the international actions, and also the expecting that the things will be changed by its own way, as expected by the policymakers. It didn't happen in that way. So therefore, we were in a kind of a situation, right, when as you correctly pointed out, when 2020, if they gone to for debt restructuring, things would have been different by now. And they said there was no reason for us to go to the IMF. Repeatedly, they reiterated their positions. And that is the prime mistake they have made. Thank you very much for very, very, very informative.
May I make a last comment, Dr. Ganeshmoorthy?
Yeah.
Yes,
Go
I
ahead,
think
please.
one last comment is that, again, I am reiterating that the only way forward, given the current macroeconomic environment and the way these variables show you, is actually empower the private sector. There is no other alternative. I think you need very serious reforms for the people, individuals, families, firms to actually do business and actually use their innovations. And government has failed. This we have to understand. Government actions will not actually materialize. Second point, as Dr. Ganeshmoorthy said, this automatic stabilization will not happen in Sri Lanka. If you believe in the neoclassical macroeconomics and think that Sri Lankan economy will recover automatically and whatever we do, and that will not happen. And you need correction of policies, a lot, correction of policies. Finally, I would like to actually thank our head of the department, Professor Dayaratna, for actually accommodating this, and also Vice Chancellor, Professor Lamans, and also Dr. Prabhat Tekanayaka, Dean of our faculty, for actually allowing us to collaborate, work with you, and also Dr. Ganeshmoorthy for excellent moderating in this regard. Thank you very much to everybody, including our venerables of the President of the Sri Lanka Economic Association. Thank you very much.
Thank you for having a great evening.
Thank you.